Hey everyone, and welcome. Today we're going to talk about a really interesting investment option that a lot of people are curious about, the RBI floating rate bond. We're going to break down exactly what they are, how they work, and help you figure out if they might be a good fit for you.
So, let me ask you something. Are you on the lookout for an investment that's genuinely safe, but you're kind of disappointed with the returns you're seeing from your typical bank fixed deposit? Well, what if there was an option backed by the government itself that might just be the answer? Okay, let's just get right to the comparison. On one hand, you have your standard bank FD. We all know it's safe. On the other, you have these RBI bonds, which are backed by the government of India. That's pretty much the safest you can get. But here's the kicker. While FDs are hovering around 6 to 7%, these bonds are currently paying out over 8%. And that little bit extra, well, that's what we're here to talk about.
All right, so first things first. What exactly are these RBI bonds? Let's cover the basics.
The easiest way to think about it is this. You're basically lending money to the government of India. It's a loan. And for lending them your money, the government pays you interest. But the key thing to remember, and it's right there in the name, is floating rate. Unlike an FD where the rate is locked in, the interest rate on these bonds actually changes over time. It adjusts to what's happening in the wider economy.
So these bonds actually popped up back in 2020. And the reason why they were created is pretty smart. The goal was to give investors a super safe option that wouldn't get stuck with a low return if interest rates in the economy suddenly shot up. Fast forward to today, and they've become a go-to choice for conservative investors who are really focused on safety and getting a steady income.
All right, so how do these things actually work in practice? Let's dive into the nitty-gritty. The interest rate, how long your money is in for, and of course, how you can actually buy them.
Okay, this is probably the question on everyone's mind, and it's really the heart of these bonds. How is that floating interest rate actually calculated?
You know, the way they calculate it is actually super simple. They just take the rate from another really popular government scheme, the National Savings Certificate, or NSC, and tack on a fixed 0.35%. That's it. So you're always guaranteed to get just a little bit more than the NSC rate.
So you do the math. Today's NSC rate of 7.7% plus that extra 0.35% gives you a pretty attractive 8.05%. But here's the floating part again. This rate gets a refresh every 6 months, so you're never really out of sync with where the market is headed.
Okay, this next part is super important. These bonds have a 7-year lock-in period, so you really have to think of this as a long-term commitment for your money.
But the great news? Getting started is incredibly easy. You can invest with as little as 1,000 rupees. And if you want to go big, there's no ceiling on how much you can put in.
So how do you actually get paid? Well, the interest you earn lands right in your bank account twice a year, like clockwork. This is what makes it a fantastic option for anyone looking for that regular, predictable income stream, especially retirees. You might be thinking, okay, this sounds good, but how do I actually buy one? Well, it's way easier than you think. You literally just log into your bank's website, whether it's SBI, HDFC, ICICI, most big banks have it. Find the investments or bonds section, pick the RBI bonds, pop in your details, and boom, you're all set.
All right, we've talked about all the great things, but you know, a smart investor always looks at both sides of the coin. So let's talk about the fine print, the important limitations you really need to know about before you even think about investing.
Yeah, it's the obvious question, isn't it? With this level of safety and a decent return, there's gotta be a catch, right? Well, there are a few trade-offs you absolutely have to consider. Okay, there are really 4 big things you need to be aware of. First, that 7-year lock-in, it's no joke. You generally can't pull your money out early, though there are some exceptions for senior citizens. Second, you can't trade these. That means you can't just sell your bond to someone else if you need the cash. Third, and this is a big one for some people, the interest is fully taxable, just like your salary income. And finally, you can't use these bonds to get a loan from a bank.
So after looking at all the pluses and the minuses, it all comes down to the big question. Are these bonds the right investment for you and your financial goals? Let's build a quick framework to help you figure that out.
So let's break it down. Who is this a perfect fit for? Well, for sure, retirees who need that steady, regular income. Also, any conservative investor who puts safety above everything else. Now, who should maybe steer clear? If you think you might need your cash back in a hurry, if you need liquidity, this isn't for you. Same goes if you're in a high tax bracket and looking for tax-free options. And remember, this is for income, not for growth. So if you're looking for something to grow in value, this isn't it.
So when you boil it all down, what's the final verdict? Think of these RBI floating rate bonds as a rock-solid, stable choice for the safe part of your investment portfolio. They are designed for one thing: steady, reliable, market-linked income.
And that pretty much wraps up our deep dive. You've got all the essential details now, so I'll leave you with a final thought for your own investment journey. Knowing what you know now, for that safe portion of your money, would you choose these RBI bonds over a traditional fixed deposit? Thanks so much for joining me.